and welcome to this edition of the Mutual Fund Guide. I'm Vandita. Shively. Joining me on the show is Nitin Agarwal, CEO at Orowealth. Welcome to the show, Nitin, and thank you so much for joining us today.
Thank you for having me here.
Yes. So, Nitin, very quickly, in order to get an in-depth picture of a portfolio's performance, rolling return plays a very important role. Give our viewers some perspective on that.
Sure. So, to give a sense of how the portfolio has performed, it's very important to look at rolling returns.
Right.
Because equity markets tend to move in cycles. Sometimes they are up, sometimes they are down. If you look at last 1 year return, maybe mid and small cap have not done that well. But if you look at last 3 years, they've done quite well. So, it's very important to look at across the periods. You should look at returns, say 1 year return over different periods and average them. That's what we call rolling return, that average 1 year return over time or average 3 year return over time. So that basically covers entire cycle and not just one particular period.
Yeah, so it's across all the time cycles without any bias.
Yes.
All right, so let's begin with our first caller who's online with us, Rakesh from Bengaluru. Hello and very good afternoon, Rakesh. What's your question?
Good afternoon, madam, and good afternoon, sir. So I'm 29 years old and I'm planning to invest 5,000 per month. This will be for 20 years. So is it okay if I invest in the fund Mirae Asset India Equity Fund?
All right. So he's 29 years and many congratulations, Rakesh, that you've thought of starting and investing in mutual funds. So what do you suggest about this fund, Mirae Asset India Equity?
So as you said, since you have a long-term horizon, equities tend to have maximum potential in the long term, and your choice of fund is also very good. Mirae Asset India is a very good performing fund. It has a good track record and it is also expected to do well in future. It has a very experienced fund manager who invests in diversified sectors. So I would say you should start the SIP as soon as possible and continue and stay invested.
So you recommend him, like he's planning to invest 5,000. So do you see like two funds there, or you just think that 5,000 in one fund is fine, or do you want to divide it like 2,500 in one, 2,500 in another?
So 5,000 is fine because this particular fund is a multi-cap fund. It will diversify the holdings in any way into large cap and mid cap.
Right.
So for this particular case, 5,000 is enough in one fund.
Right. Okay. So that's the advice coming in for you, Rakesh. Always see why you are investing and what's your horizon. Divide it between short-term goals and long-term goals. All right. We move on to our next email. That's from Nirav, who's from Gujarat. He's 28 years old. He's investing 1,000 rupees each in DSP Small Cap since December 2016. Aditya Birla Sun Life Equity since September 2016. SBI Blue Chip since March 2017 and HDFC Hybrid Equity Fund since May 2018. His objective is wealth creation and to accumulate corpus for his retirement. Is his portfolio correct, Nitin?
So first of all, if I look at the scheme selection, it's quite good.
All right.
Also, as the goal is retirement and there are 30 years to retirement, by finance theory, you should have significant allocation in equities, which is already reflected in the portfolio.
All right.
One aspect where he should be cautious is that he's investing in small cap funds. After the recent SEBI recategorization, the small cap funds are funds beyond the top 250 market cap.
Right.
So this space is not very well researched, and it can throw up interesting investing opportunities, but they're also very volatile. So,
absolutely.
So if his individual risk preference is not very risk taking, then he can move that small cap fund into a multi cap fund.
All right.
Second important thing is the high equity allocation is okay for now because there's still 30 years to retirement. But as you approach retirement, you should de-risk your portfolio. You should move equity into debt because you don't want to end up in a situation where just before retirement there's a market downturn and you lose your retirement savings.
Right.
So as you approach retirement, de-risk your portfolio, move into debt from equity.
All right. So one suggestion, the scheme selection looks good. And you think that small cap could be riskier here because markets are volatile, of course. And the riskier, the larger returns.
Right.
So you think that small caps could be moved to multi-caps. And when he moves towards his retirement, then he could probably look towards, shifting towards debt funds.
Yes.
Right. So that's the advice for you, Nirav. We have another email that's from M. Ramesh, who's from Adilabad, Telangana. He has emailed up his query And if you look at his query, let me just have a look. Yeah. So his age is 55 years and he has invested via lump sum 10,000 rupees in HDFC Hybrid Equity and ABSL Frontline Equity Fund and rupees 1 lakh in SBI Blue Chip Fund. What is the outlook? If you could advise a good debt fund for him as well.
So again, I mean, the schemes he has selected are like very good schemes. But one concern for me is that he mentioned his age is 55. So I assume whatever goals he's saving for, be it child education or marriage or retirement, are very nearby.
Correct.
In that case, it's not advisable to hold 100% equity.
Right.
So I would suggest that move a significant amount of your portfolio into debt, and I think he's already thinking about debt, which is a good thing. So we would recommend him to hold short-term maturity debt.
Short-term maturity
because they are less sensitive to interest rate risk and will give them better risk-adjusted return. So in terms of fund suggestions, maybe HDFC short-term or Franklin ultra-short fund.
Right, and he has invested via lump sum. So, are you okay with this 1 lakh lump sum in SBI Blue Chip Fund, or what do you recommend?
So, I guess he is already invested. But typically at this close to retirement, you can shift slightly portfolio. You can start an STP from equity to debt and move your portfolio into debt over time.
Okay, so he can probably that 60-40 thumb rule that we talk about generally.
Right.
All right, because of course his age is also 55 years.
Correct.
Also, I always have this question with most of the advisors who come on board. Once you reach the age of retirement, capital protection oriented schemes are really popular. So what do you have to say on that? If you could just throw some light on that?
See, at that age, it's very important to protect capital, but it also we should do basically depends on what is your portfolio size, what is your net worth.
Right.
You need to protect decent portion of net worth because there will be expenses in future.
Right.
If you have some money left, you can still invest in equities, but it should not be a big portion of your net worth.
Right.
So look at what is your investment portfolio. If you want to still play in equity, play with a smaller amount.
All right. So that's the advice coming in for you. We have our next caller, Mr. Sunil Makhija, who's online from Mumbai. Hello, sir. What's your question?
Yeah, actually, I have shifted my fund from ICICI balance fund to five different mutual funds by an advice from a wealth creator. And the fund names are Aditya Birla Sun Life Equity Fund Growth, Can Emerging Equities Growth Fund, HDFC Mid Cap Opportunities Fund Growth, Kotak Emerging Equity Scheme Growth, and Mirae Asset India Equity Fund Growth, regular growth. So I want to know if this is a good strategy for me. Like all have been shifted to equity growth fund. Is it quite safe or is it very aggressive?
All right. Yes, Mr. Makhija, of course, we have our mutual fund expert, Mr. Nitin. Yes, Nitin, what do you have to say?
So actually the portfolio is very mid-cap heavy. It's very aggressive portfolio and duration, the horizon is just 5 years. So it's definitely risky portfolio, very aggressive portfolio.
Right.
We would recommend him to move into more safer schemes like hybrid or balanced funds.
Right.
He can move a significant portion of his funds from mid-cap funds like Kotak Emerging Equity into more safer funds like ICICI Equity and Debt Fund or HDFC Hybrid Fund. This will give him more stability in the portfolio and will also help him gain like better risk-adjusted return.
Right. So moving on, to more of multi-cap funds.
Multi-cap, large cap, and even hybrid or debt funds.
Hybrid or debt funds.
Yes.
So do you have any follow-up question, Mr. Sunil?
Yeah, actually, it is done by a wealth creator. So can I ask him to shift the funds to hybrid funds?
Sure.
Because they are not interested in hybrid funds. They are very keen on this funds, which I have told you.
So the thing is, you should definitely have a chat with your advisor. Tell them that what is the risk in this portfolio, because this portfolio could easily go down quite a lot if markets are not doing well. Are you comfortable with that kind of risk? So this is a discussion you need to have with your advisor. It's not about the scheme selection, it's more about the asset allocation. So right now it's very mid cap heavy, which is very volatile in nature. And you yourself said in your question that maybe you don't want to take that much risk. So that is the conversation you need to have with your advisor. If you are moderate risk taker, then definitely you should move to debt funds.
Right. So the question is more on the risk appetite here. So you need to work on that, and maybe you can sit with your advisor and talk about why he has selected these funds for you, and you can bring in what Mr. Nitin has also mentioned in your portfolio. So let's see what the advisor has to say.
Sure.
All right, we move on to our next email. That's from Frotul Mondol, who's from Kolkata. He has emailed us. He's investing through SIP of 1,000 rupees each in HDFC Mid Cap Opportunity Fund, Kotak Standard Multi-Cap Fund, Motilal Oswal Multi-Cap 35 Fund, Tata India Consumer Fund, and Reliance Small Cap Fund. He wants to accumulate a corpus for his son's college education and can hold till March 2023, which is 5 years, I think. How much will he earn? How is his fund allocation?
Okay, so one thing I want to highlight here is the schemes you hold in a portfolio.
Right.
Is one big factor is what are you saving for?
Absolutely.
And here he's saving for his child's education,
Right.
which is just 5 years away. In that scenario, it's not advisable to hold so much equity. Because see, I mean, he cannot delay the education by 2 years.
Right.
So we have to be very cautious on what schemes we are holding. We think this is a very high risk portfolio.
Okay.
So he definitely needs to move to more safer portfolio because the nature of the goal he is saving for. Second thing is that typically for this 5-year horizon for a child education goal, our preference is to have a 60 equity 40 debt portfolio.
Right.
So he needs to buy some debt funds, which are short-term debt funds. He also needs to move a bit into large cap funds, which are kind of missing in the portfolio.
You think dynamic bond schemes would be good for him?
We personally don't recommend dynamic bond fund because it can be replicated using large cap and debt fund.
Alright.
It's better to have two different schemes which are specialized in their own asset class than having a mixture. So we would say that you buy two funds rather than a dynamic bond fund, a large cap fund and a debt fund.
All right. So, on that note, just one question here. So, a lot of people, they have short-term goals. Of course, they invest for long-term horizon also, but they have short-term goals.
Right.
And they plan to take out some money, like they have a strategy to take out. So, what do you really recommend to those people? Like, they should plan this 1 year in advance, 6 months in advance. So what do you recommend them? How should the exit strategy, play here?
So, the thing is, we can try and plan, but like the unexpected always happens.
Right.
So the good thing is you should start investing as soon as possible. As soon as you realize that you have some goal to achieve. Always invest in open-ended funds, so that if something goes wrong, you can basically take out money anytime. Have some basically debt funds in a portfolio because that can give you some liquidity cushion.
Right.
They have zero exit loads and very easy to redeem and get money out of it. So I mean that's the thing. I mean can't plan for everything.
Right. So for some occasions you cannot, but some occasions like that your child's education, you have a short-term vacation or something like that.
Right.
So maybe for that they can plan a strategy before they exit or move out of a scheme.
Correct.
All right, that was really nice talking to you. It was really nice talking to you, Mr. Nitin. Viewers, that's all for this edition of the Mutual Fund Guide. That's how you save, invest and prosper. Thanks for watching us today and stay tuned for more news and updates on the other side.